Welcome. We are looking today at what some are calling, well, maybe the most urgent signal in finance for decades. Something the mainstream might be seriously overlooking.
Yeah, it's pretty striking when you look at precious metals. Gold just recently powered past $4,000 an ounce.
Wow.
And
$4,000.
silver's up near $49. That's the highest it's been since, what, 2011?
Over a decade, right?
Exactly. And this isn't just, a good run. Peter Schiff, the economist, in his latest analysis, he's flat out calling it a global alarm bell.
A global alarm bell. Okay, so that's our focus today, really unpacking this warning based directly on Schiff's thinking. He's arguing this huge surge isn't random.
No, he thinks it's a direct response to what he sees as an impending collapse of confidence in paper money.
And specifically hitting the US dollar's role as the world's reserve currency.
That's the heart of it. This is really about the structure of the global monetary system, not just a commodity play.
Right. So this is essential information if you hold dollars, dollar assets, basically, if you participate in the economy.
You really need to understand the argument here, because if this analysis is correct, well, the fallout could be massive.
Okay, before we get into the weeds on this, please take a moment and subscribe to Cradevia right now. We delivered this kind of essential knowledge, timely analysis on these big global shifts directly to you. All right, let's start with the main idea. Schiff's core point seems to be that gold is forward-looking. It sees trouble coming before it shows up in the official numbers. How does he back that up?
Well, he draws this really compelling comparison to 2008. Remember the subprime mortgage crisis?
Of course.
He says subprime housing wasn't the whole problem, but it was the weakest link in the chain. It was fragile.
Okay.
And because it was so sensitive, it cracked first.
Yeah.
It showed the stress long before, the big banks started wobbling and the whole system seized up.
So the first domino, essentially. If subprime was the weak link then, what's playing that role now, according to Schiff?
Today, he argues, gold is the new subprime. It's the asset that's most sensitive to the threat against, specifically, U.S. government credit and the whole global money system.
So gold's acting like that early warning, reflecting danger before the S&P 500 wakes up to it.
That's the idea. It's signaling a systemic issue that maybe U.S. stocks and bonds are still sort of ignoring or maybe denying.
And he points to signs that this instability isn't just theoretical, right? Things already happening in the market that seem contradictory, like interest rates.
Yeah, that's what he calls the ultimate paradox. You've got the Federal Reserve cutting short-term interest rates, trying to stimulate things.
Standard procedure trying to make borrowing cheaper.
Right. But at the same time, long-term interest rates, like the 10-year Treasury yield, they've been going up.
Wait, that doesn't sound right. If the Fed's loosening money at the short end, shouldn't long-term rates follow, or at least stay stable? Why would bond investors demand more yield for holding debt longer?
Well, this gets back to that sovereign credit risk. The market, especially maybe international bond buyers, they're not buying the Fed narrative about inflation being under control or temporary.
They see more inflation coming down the line.
They're anticipating huge ongoing deficits, more money printing, and therefore more inflation long term. So if you're going to lend the U.S. government money for 10 years...
You want a higher return to compensate for the risk your money will be worth less later.
Exactly. It's basically the bond market saying, we're losing confidence in your ability to manage your finances without inflating away the debt.
Okay, that connects directly to the dollar's performance then, because we know the dollar's taken a hit this year.
A big hit, down about 10% for the year. That's its worst performance in, 50 years?
Half a century. Wow.
Yeah. So that dollar decline is already a massive red flag. Gold soaring is, in a way, just reflecting that. The unit of account, the dollar, is falling hard. And Schiff's point is, this is probably just the beginning.
Okay, let's dig into the core vulnerability then. The dollar's Achilles heel, that reserve status. We hear the term all the time. Can you break down what it actually means for the U.S. economy and why losing it would be so, catastrophic?
Sure. So the reserve status is this really extraordinary privilege the U.S. got after World War II. Basically, it lets us buy imports, real goods and services from other countries, by just printing our own currency, dollars.
We send paper, they send us stuff?
Pretty much. Paper-backed only by the full faith and credit of the U.S. government. Schiff calls this privilege the pillar, holding up what he terms America's phony economy.
And by phony economy, he means one based on consuming more than we produce.
Exactly. Funded by issuing debt, IOUs, that the rest of the world, because of that reserve status, has historically been willing or even required to hold.
So if that status goes away, if the world stops wanting those dollars or trusting them,
Then the whole structure potentially comes crashing down. The cost of imported goods would skyrocket almost overnight. Funding our massive government deficits would become incredibly painful, if not impossible on current terms. The standard of living, built on cheap imports and readily available credit, couldn't be sustained.
so gold's rising everywhere because of general inflation fears. But for the US, the stakes are much higher because we have this unique position to lose.
That's the critical point. Other countries face inflation, sure, but the U.S. faces a potential economic reckoning because our global position has allowed us to, kick the can down the road much further than anyone else, and the world seems to be noticing.
And acting on it, we see this in how central banks are behaving, right? Quietly.
Very quietly, but the data is clear. Schiff points out that foreign central banks are steadily reducing their holdings of U.S. Treasury bonds.
Selling US debt.
And at the same time, they're aggressively buying physical gold. There's a really striking statistic he highlights. Central banks in major economies, think China, Russia, India, Saudi Arabia, Turkey. They've collectively bought over 1,200 tons of gold just this year.
1,200 tons. That doesn't sound like just tweaking the portfolio mix. That sounds like preparation.
It looks like preparation for a financial storm, specifically one centered on the dollar. They're building up reserves of something they trust outside the dollar system. It's a massive, coordinated move towards insulation.
They're signaling they think the next big crisis is a dollar crisis, and gold is their lifeboat.
That seems to be the interpretation, yes. Gold is the asset they trust when the value of sovereign promises comes into question.
This whole situation really forces you to reconsider the stability we often take for granted. And look, if you're finding this analysis valuable, please subscribe to reshape. Staying informed about these fundamental shifts in monetary power is crucial right now. Okay, let's connect this back to history. Schiff draws a strong parallel between today's gold surge and the 1970s. He says the scale of the current move, 54% year to date?
Yeah, around 54%. He argues a move like that is only really comparable to what happened right after a huge monetary event in the early 70s.
1971. Nixon closing the gold window.
Exactly. Before 1971, the U.S. dollar, at least internationally between central banks, was theoretically convertible to gold. Foreign governments could show up with $35 and demand an ounce of gold from the U.S. Treasury.
It was an IOU for real money, for gold.
It was, but the U.S. was printing too many dollars, running deficits, and didn't have enough gold to back them all up. So in August 71, Nixon unilaterally slammed that window shut. He basically said, those IOUs, they're no longer redeemable for gold.
We essentially defaulted on the promise.
It was, from Schiff's perspective, a 100% default on the core promise backing the dollar at the time. And that move ushered in the purely fiat currency system we have today. The massive gold rally in the 70s was the market reacting to that fundamental breach of trust.
So Schiff sees today's gold surge in its speed and scale as signaling a similar, maybe even larger, loss of confidence in the dollar's fundamental value proposition now.
That's precisely his argument. He believes we're seeing the echoes of 1971, but potentially on a grander scale, reflecting decades more of debt accumulation and currency creation.
Now, this is a very dramatic, very bearish outlook. To be fair, what do mainstream economists typically say is driving gold higher? Those who don't buy into the imminent collapse narrative.
That's important context, absolutely. The mainstream view usually points to more, conventional factors. Things like hedging against the current admittedly high levels of consumer price inflation.
Standard inflation hedge argument.
Right, or geopolitical risks. Wars, instability in various regions. That tends to boost safe haven assets like gold. And sometimes it's just technicals and momentum. Gold break through key price levels, so traders jumped in.
So uncertainty, inflation, market dynamics, but not necessarily a fundamental crisis of the dollar system itself.
Generally, yes. They'd argue the U.S. economy still has structural advantages. The dollar's role in global trade is deeply embedded. It's the cleanest shirt in the dirty laundry, so to speak.
Yeah.
They see the reserve status as much more resilient than Schiff suggests.
Okay, that's the counter-argument. Schiff, however, sounds like he sees those points as missing the bigger picture, perhaps even denial. So if we follow his logic that the confidence game is ending, what does he advise investors actually do? He seems particularly concerned about waiting.
Yeah, he warns against waiting for a dip. He describes the market as skittish. A lot of people, even those who believe in gold long-term, are apparently hoping for a pullback, maybe back to $3,800 after it touched $4,000.
Waiting for a better entry point seems logical.
It seems logical, But he argues there's just too much money sitting on the sidelines waiting to buy gold.
So any dip gets bought up instantly.
That's the risk.
Yeah.
Any correction could be incredibly short and shallow. You wait for $3,800. Maybe it never comes, or it touches it for 5 minutes. The next thing you know, it's $5,000.
And the psychological cost of missing out if he's right about the long-term trajectory.
Exactly. If gold is really headed for $10,000, $20,000, as he predicts in this kind of scenario, then hesitating now to save maybe $200 an ounce could end up being a huge financial mistake down the road. The biggest risk is inaction.
Okay, so if inaction is the risk, what's the action? This sounds like it requires a pretty drastic shift in portfolio strategy. What assets does he say to get out of?
The advice is pretty stark. He says exit U.S. bonds. That's where he expects the worst damage, as inflation erodes their fixed returns. Also, exit U.S. stocks, which he sees as overvalued and dependent on this phony debt-fueled economy.
And cash. U.S. dollars.
Crucially, yes. Exit U.S. cash, too. Selling stocks or bonds just to hold dollars means you're still holding the asset that's fundamentally being devalued. That's the core threat.
Wow. Bonds, stocks, cash. That's basically the foundation of most people's retirement savings. So if you exit those, where do you put the capital?
You rotate into real, tangible assets, and importantly, assets outside the United States.
Like what specifically?
He suggests things like foreign dividend-paying stocks, arguing they're cheaper than U.S. stocks and benefit from a falling dollar. Commodities generally, as inflation hedges, and of course physical gold and silver. He emphasizes owning the physical metal, not just paper proxies.
So it's not just diversification, it's almost like financial immigration, getting your wealth outside the U.S. system entirely.
That does seem to be the implication. It's radical, yes, but it follows directly from his premise that the illusion of a strong U.S. economy built on decades of debt and what he sees as uncontrollable inflation is finally shattering. The system is choking on its own medicine, and gold is screaming it.
Okay, let's try to bring this together. What's the core takeaway for someone listening to this analysis?
I think the key thought is this. Schiff believes the Federal Reserve is trapped. It can't raise interest rates significantly without potentially collapsing the massive debt structure. Government, corporate, household debt.
Right. Higher rates make servicing debt impossible for many.
But it also can't keep cutting rates or printing money without accelerating the dollar's devaluation and worsening inflation. They're caught between a rock and a hard place.
So the fundamental question becomes, has the music stopped?
Has the global confidence game, the one that's propped up U.S. economic dominance for 50 years, finally reached its end? That's the unavoidable question this analysis raises.
So if you remember one thing from our discussion today, maybe it should be Schiff's provocative claim. Gold isn't actually going up.
Right. He says it's everything else, particularly the value of paper assets like dollars, that's going down. Gold is just reflecting that reality.
A fundamental repricing of value in the face of monetary debasement.
That's the argument. It's a potential paradigm shift, and you really need to be paying attention.
Absolutely. For ongoing insights and analysis on these critical global shifts, make sure you subscribe to CR Eblovia. Hit that subscribe button now. We'll be back next time with more essential analysis for you.